Hi everyone, welcome to Garan Madnani ACC classes. We will continue the next the chapter of chapter 1. This is a part A, audit framework and regulations. There are 5 parts. It is one of the parts. So we will see this is chapter 1, audit and other assurance engagements. We will get to know about the audit, about the assurance engagements, how audit works. There's so much in this chapter we will learn about. The purpose of external audit engagements. Why external audit? You heard about the term audit, you heard about that auditors audit the companies, you heard about the scams also. There's so much big role play auditor in every company. What is the purpose of audit? Why audit conducted? The basic purpose of audit is just to express an opinion on the whether the financial statements are prepared in all material aspects within applicable financial reporting framework. We have the financial statements to audit. As an auditor, the company will provide me the financial statements, the accounts of the company. What I have to do, I will do the audit of each and every account. I will see whether the company has prepared the account according to the IFRS or not. I have to see each IFRS, each entry, each accounting statements, each accounts to verify that it is accurately made. There are no clerical errors like numbers mistake, or there should be no accounts mistake. There's so much more than that also. Submitting the tax on the time, we have to verify each and everything of the company. So I will see whether the company is doing the proper work or not. I have to give my opinion on this. I have to give opinion on this, whether this is prepared in all material specs. It's preparing according to the requirement of the IFRS of the government. So we have to see everything. We give our opinion on that and we verify that. It is an example of assuring engagements. There's so many assurance engagement. It is one of those examples. There are two types of audit. One is statutory audit, second is non-statutory audit. First, we will get to know about the statutory audit. These are audits which are required by law. If government set the criteria for some companies that these companies should be audited at any cost. So in the UK, most companies who are registered under the Companies Act 2006 are required to an audit. Most listed companies who are traded in the stock exchange, they should have audit, because to give the meaningful results to the people, to the shareholders, to the stakeholders, to give the actual picture of the organization, which is very important in today's time. So many scams occur in the past. So shareholders, if you want shareholders to gain if you want to gain the goodwill in the market, then you have to issue a proper statements, proper everything, proper information to the public, so that they can trust you, they can trust, so that they can invest and earn more. Advantage of statutory audit. It's a good thing. If someone opinion provided by the auditors, if auditors audit your statements, and somebody who is professional doing a work, so it's great. Professional accountants review the accounts system of the company. Auditor, who is auditor, who which is qualified. Suppose ACCA is like, if I talk about the ACCA, education needed to complete the papers, need the practical experience, then you will be the qualified auditor. So professional accountants review the account system of the company. While you were while you're studying, you're also doing some practical training also. You will learn so much from that, you will apply in the actual environment. So they are professionals. They might found fraud and error. So many companies in the world, they do lots of millions of errors. If you see the financial statements of some companies, when you're doing audit, you will get to know so many errors are done by the internal management. They rectify that and save the important profit of the company. They might send the wrong credit with wrong account. And more errors are done in the company. They found the errors, rectify them. They save a lot of the company money. They might found fraud also, which is the biggest thing. If I talk about the big companies, those who are the partners, those who invest in the company, they are not sitting with the directors. They are not working day to day according to the activity. So they need the assurance that they can trust the company and they're running, they're gaining profits, actual profits. Nobody is doing some fraud in the company. Nobody is manipulating the money. So it's very important that we should they might run some fraud and they will check the accounts. They might found some fraud which is done by the internal management. So this is the benefit of statutory audit. Now it's non-statutory audit. Statutory audit is something which is required by law, which is mandatory. Non-statutory audit, it is not required by the law, it is not mandatory. It is done by voluntary. If you want to do a audit, like partners sitting in the Delhi and someone running the Bangalore, company running the Bangalore, so they want the audited financial statements. They want that some independent person do the audit, and they give the assurance because partners trust auditors because they are the independent person, they are professional, they are qualified, so they trust them and they want somebody independent should do the audit so they can gain the assurance. These are not required by law. These are conducted because the owner voluntarily want to conduct the audit. As I said, advantage of non-statutory audit. Accounts are more susceptible to taxation authorities. If you submit the tax, they want that you should submit the audited financial statements. No one will verify. If you take a loan from the bank, they first will say to you that we need the audited financial statements. So this is a primary requirement. So if you didn't, if you are doing the audit for the company, so if some company appoint the auditors voluntarily, so it's a good. They can be a financial statement can be accepted everywhere. It will be help to take a loan overdraft facilities. Helpful for sleeping partner. Sleeping partner is who is not participating in the day-to-day activities of the company, but he is giving his share to the partners to share the profit losses. So it's good for him, so he can see what the actual profit and loss is, and then he will verify that. Accountability, stewardship, and agency. Accountability is a state of being accountable. That is, directors are accountable to shareholders. Shareholders are a person who invests the money into the company, and directors are the person who manage the company. Stewardship, duty is an obligation of a person who manage another person's property. That is, director act as stewards of the shareholder investments. Shareholder invests the money in the company, they want the return. So directors manage the company, they take the salaries. So they are steward to the shareholder. They are responsible for managing the money of shareholders, to manage the money, and they can work with that money, and that works. Agents who are responsible to provide a particular service. That is, directors are agents to the shareholders. Directors are agents of the shareholders. They are working for shareholders. Shareholders are providing the money in a form of salary to the directors. So they are agents of the shareholders. You can see in this diagram, directors are accountable to these people. These are shareholders. Assurance engagement. What is assurance engagement? First, from the assurance, it is auditors done the audit, they are giving the assurance to the people, to the shareholders, to the stakeholders. This is the engagement which a practitioner aims to obtain sufficient appropriate evidence in order to express a conclusion designed to enhance the degree of confidence of the intended user other than the responsible party about the outcome of the measurement or evaluation of an underlying subject matter against criteria. This is the definition given by the IFAC 2016E. This what is IFAC? International Federation of Accountants. So this is the definition given by them. A practitioners auditor whose aim is to obtain the sufficient appropriate evidence When you're doing the audit, if you find some errors, collect that error in the form of photocopies, any evidence you can collect. You will gain the evidence, then you can submit to the management that these are the fraud or error I found. In order to express a conclusion designed to enhance the degree of confidence of the intended users, other than the responsible party about the outcome of the measurement or evaluation of the criteria. There's some criteria, you know the IFRS, you know the standards, auditor done the audit according to the standards. There's so much law and regulations internally made by the company, so auditors see their, if I'm saying if a person is allowing some, many companies employees company give the benefit to the employees that they can travel to the cities for the work, so the authorized expenses for this amount, suppose a 1000 per day or $100 per day, so this is the authorized amount by the company. So this is the authorized amount by the company, so we have to see an audit whether the company, uh, whether the person claiming the amount is up to that amount or lower than. If he is charging more than that and company along, that's a problem. So I hope you understand how the audit goes. We check the according to the statements, we check according to the standards. So we give the assurance engagements. We This is the assurance engagement where practitioners and company involved, and practitioner give their opinion. Elements of an assurance engagement. What are the elements of an assurance engagement? You will learn more about this assurance engagement here. Three-party relationship, subject matter, suitable criteria, evidence, and assurance report. These five I will explain you, in a single slide, that what it is. You will learn more better about this. Three-party relationship. This is a whole concept. Assurance engagement is a involvement of three parties. First is practitioner. Who is practitioner? Practitioner is auditor, who audit the financial statements. Second is intended user. Who are intended user here? Intended user shareholders, who will gain from this audit. Responsible party. Responsible party is directors, who is responsible for the company, who managing the company. These are the responsible party. Subject matter. Subject matter is the thing what we have to do. Why we're doing audit. What is the subject matter for this? Financial performance, historical financial performance. We check the historical financial statements. You know, uh, in commerce, in audit, what happened? Financial statements are prepared, suppose from 1st April to 31st March. We audit the statements after 31st March. There's interim audit also, but I'm assuming we are auditing the final account. So these are historical account. They prepare for 1st April to 31st March. So we test the historical financial performance of the company. Non-financial performance, key performance indicators like the satisfaction of employees, satisfaction of customers. These are the key performance indicators. Processes, internal control, like there's so much internal control in the company. When who is authorizing the amount, who is giving, who have the authority, who have the responsibility. We will check and we verify that it is accurate and proper in the financial statements. Behavior, comply with laws and regulations, like so many laws in the company, so many laws in the city, in country. So we have to check whether companies following every law, if they are implying or not. Suitable criteria is needed to reach an opinion. Like we while we checking the financial statements, we the criteria is IFRS. We check according to the IFRS whether the accounts are prepared according to the IFRS or not. Evidence, there should be sufficient appropriate evidence for assurance. If you're doing audit, as I said earlier also, you need the evidence. If I talk about the, suppose some advocacy or advocate cases in the court, you need the evidence to submit in the form of judge, that I have this evidence, I have this proof that you know person does this crime, so I have this proof that I'm submitting this proof. Just collect the evidence and submit to the judge, and the case will be solved. Same thing work here. There should be sufficient appropriate evidence for assurance. If you find some error, if you find some fraud, then collect this. And if you find some error in the financial statements, suppose in the cash account, then suppose a journal entry is gone wrong or some amount is a difference, so check each and every account which is trailed for that. If there's so much we buy from cash, so check the stock entry, check everything which is related to the cash, so that everything is accurate according to it should be. So we should collect that evidence and submit to the management, submit to the seniors that we have collected this, please check this, and found the we have found this and please correct that. An assurance report. Auditor form an opinion on the financial statements and give the assurance to intended users. That is reasonable assurance or limited assurance. We will see in the next video the reasonable assurance or limited assurance. At the end of the day, what auditors do, they audit the financial statement and they give you the auditor's report. I will show in the next video how a report looks like of the company. So we give the assurance to the company that this is the auditor's report. We have checked everything. It is accurate according to our knowledge. We give the reasonable assurance or limited assurance, which we see in the next video. Thanks for watching. If you like my video, then please raise a thumbs up. And if you're not subscribed my channel, then please subscribe. Thank you. See you in the next video.